What happens if our deal needs more money? Well, it depends on what kind of deal it is. It depends if you've got a syndication, which is a project, or a fund, which is an ongoing arrangement. It depends on the relationship you have with your investors and what you've defined. There's a lot of issues here, so we'll take a handful of them. We'll probably end up making a second video to deal with some of the other issues. Here are the first big ones. If you've got a syndication, and let's say you buy an apartment building and you're doing a project, and that project, for whatever reason, starts to run low on funds and you need more capital. Well, you can do what's called a capital call. You can go back to the investors and you can tell those investors, hey, look, for whatever reason, we ran short of money and each person has to put in another 50 grand. Well, those investors will undoubtedly be pretty upset that they have to cough up more money that they didn't anticipate, or that they weren't told that they have to come up with in advance. So this sort of thing is not popular among investors, and you can understand why. Put yourself in their shoes and see how you'd feel if somebody had to ask you for some extra money. So what we typically do is we do not require there to be a capital call. Now, a capital call is one of those terms. A couple weeks ago, we released a video that was on investor-friendly terms. Very un-investor friendly, very unfriendly to investors, because this is the kind of thing that can really give somebody a surprise. They might not have ready capital that is ready to go, and so they might not have liquidity, or they might not have the ability to participate, and a capital call provision could require them to suffer some kind of penalty or other injury if they don't participate. We would much rather say that the investors get the first right to put in more money, but they're not required to put in more money. And we put the responsibility back onto the promoter. And here's the deal. There'll be people that disagree with this, but you will have a very hard time raising your capital if you have a capital call provision in your documents, because the investors are going to say, well, they're not thinking about the upside. They're always thinking about the downside. They're going to say, well, gee, if you have a problem and I got to cough this up and I don't have the money and I got to set it aside, then really I could have all sorts of other problems. So I don't want to participate. I'd rather go into something that's a little more safe. So instead, we set this up where there is no capital call requirement. They do get the first right of refusal. So in other words, if we ask for more money, they have the first opportunity to put the money in, but there's no obligation for them to contribute. If they don't contribute, then we go to third parties, we go to outside people. So the first thing that would happen is that we go to the inside investors and say, do you want more? And they can say, we'll put up more. We can also say, would you like more than just the proportion that you're entitled to? Because now we have to raise extra because there are some people that aren't participating. And if that happens, then those people could end up with a larger share than they originally bought. There could be sort of a punitive arrangement in terms of the way that the dilution works. Because think of it like this. If the investor chooses not to add capital to the situation and you have to go raise capital at a lower price than maybe the original investors came in, the investors are going to end up owning less if they don't contribute more capital to keep their percentage of ownership and their percentage of profit sharing on par with what it was before. So they will suffer a little bit of damage, but they don't have to cough up the cash. The people that come in later may end up getting a better deal. I mean, the truth is that if you're in a difficult situation and somebody's going to kind of save your hide, they would expect to get a particularly good situation. And by the way, you know, whatever percentage of ownership you have as a promoter, that immediately goes onto the table in a situation where there's a capital call, because any savvy investor who comes in to save your bacon is going to say, you know what, I'll take whatever the price is, but I also want some percentage of the manager's share if I'm going to put in extra money. So you as the promoter have to be very careful not to get yourself into a situation like this. And the way you do that is by raising enough money up front. If you don't raise enough working capital, if you don't really think about your reserves, and if you don't plan for this, then you're the one that's got to come up with the money, or you got to find people to put the money up, and there's a very good chance that they're going to come after your share. So there are other issues related to capital calls and raising more money, but we'll deal with that in a subsequent video. In the meantime, go out and stake your claim.